Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the monthly Movers and Shakers show where I look at the ongoing trends within the markets, the top performers, the underperformers, and try to ascertain whether these trends are going to continue or whether we're going to see reversals come into play. In terms of the different areas I'm going to look at, the first we're going to be looking at is the indices space. And you can see over the course of the past month, we have seen the Hang Seng really outperform with a near 6% gain over the course of the month. Now, the Hang Seng has been a big underperformer in the past. So this strength really appears to be a bounce back rather than indicative of an ongoing long-term trend. So some concern should be cast over that. We've also seen on the bottom end of things, the Russell 2000 down 7% over the course of the month. So let's look first and foremost at the big picture for these markets. This is the look over the course of a year for some of the main indices. And what we can see here is that the Hang Seng is at the bottom. So you can see that big rally that has taken place of late. Really, it's a catch-up play. It's not necessarily something that is a continuation of a wider trend in play here. And we've actually seen some weakening for some of the big top performers. So it's a tightening in terms of some of the different movers within this sphere. And certainly it's something that has been notable because of what's happening with the likes of the FTSE 100 in particular, gaining ground, setting habitual daily record highs at a time when we're seeing US indices coming off in a meaningful manner. So that tightening has brought significant inflows for Chinese stocks. Certainly more recently, we're seeing a bounce in terms of real estate stocks as well, and some optimism returning to that area. But from the perspective of the Hang Seng, I wouldn't necessarily say that this is something that would signal a massive rebound for this market quite yet, just off the back of 1 month. Now, here's the long-term picture. So this is the weekly time frame. You can see very clearly that we're within a downtrend here. We've got sort of trendline resistance that has been broken, though. So this does call into question whether we've broken out of that trend and whether we've seen a bottom for this market. Now, the fact that we have seen this rally taking place around those previous 2022 lows does give us some confidence that perhaps we have bottomed out here. If we're looking at this recent trend, you've seen that trend line break taking shape here, but we've also got the sort of nearer term decline down here. We've got this pattern of, if we go into the daily time frame, we've got this pattern of lower highs and lower lows that has been negated with a break up through this 171.84. So all of this points towards the potential for further upside in this market. But nonetheless, you can also see we've got this ascending trend line coming into play here. And we've rallied into that, respected it absolutely perfectly. And now we're seeing a big bearish engulfing as we kick off the new month. So I think there's a good chance that we do see near-term downside coming into play, if only to see a retracement. So doesn't necessarily mean that this is the beginning of a next big move that's going to continue this wider trend, because there are some tentative signals in terms of the trend line break, the break up through this 171.84 that signal the potential for us to have bottomed out. But over the near term, there's a possibility we start to give back some of the gains that we've seen over the course of the past month, as we've rallied into this trendline resistance and now looking to post a potential bearish engulfing to kick off the new month. Here is the 4-hour chart. We can see taking out that first initial low that we have at 176.45. The next key level to be watching out for here is 175.46. A break below that level points towards further near-term downside. So there's certainly some caution that needs to be held really when you're looking for longs in this index, but we are seeing some tentative signs that we may have bottomed out. Look out for the potential for near-term downside, though, as this rather overextended move looks like it could start coming under pressure. In terms of the Russell 2000, this is a market, if we look on the weekly time frame, that has been largely rotating over the last year and a bit. The breakup through this zone of resistance has been notable, though you can see these prior peaks. Not sure why that's drawn it there. There we go. So we've got this 2007 up to 2030. That zone has been broken. If you look out on the sort of wider time frame, that points towards the possibility of this having sort of represented a multi-stage bottoming pattern, essentially, before we rebound back up towards your sort of 2400 kind of area. But nonetheless, you can see this breakdown through trendline support coming into play. And certainly the problem that we have here is that we're seeing that continued pushback in terms of expectations for the Federal Reserve in terms of cutting interest rates. And bear in mind that the Russell 2000 has a huge amount of companies within it that are not profitable. They are reliant on borrowing to be able to stay afloat as they essentially seek a move towards profitability or a buyout. So this is the kind of market that will do particularly well when markets look like we're heading towards that interest rate cut and that equity markets are in a particularly bullish mode. But when we see concerns over reinflation, the pushing out in terms of those interest rate cut expectations, this is the kind of market that's likely to suffer. And that's exactly what has happened recently. The breakdown through trendline support, also that break through this 2007 area, it's just above that first swing low, gives us that sell signal. Now, we've seen this sort of rally staged over the latter part of the month. But I do think there's risk that we could see this essentially representing a sort of retracement phase before we see this market head lower once again. A breakdown through this more recent swing low of 1957 would give us greater confidence of that coming into fruition. But certainly this is a market that by and large over the years has struggled to really exit this pattern that we saw it enter back in sort of early Q1 2022. Whilst we did see the signals that was happening earlier in the year, we've seen that faltering quite heavily, and we're seeing it starting to roll over. So there are some risks that if we see risk sentiment sour further, that we do see further underperformance for this market that has performed particularly well at the back end of last year and the beginning of this new year. Now let's look back at the performers, but let's look at the second area, and that is the FX market. The US dollar doing particularly well, which is not necessarily too surprising as we see those rate cut expectations push further out. Bear in mind, a month ago, markets were expecting a 60% chance of a rate cut in June. Just a month later, it's been pushed back, not to July, but to December. And so that massive shift in terms of expectations on when we're going to see a rate cut does impact sentiment around the US dollar, which has been doing well, both off the idea of interest rate differentials, but also off the idea of it being a haven. So it's sort of one on the double front here. And then at the same time, we've seen the Japanese yen weakening once again. I mean, quite frankly, you could look back over the past 12 months and most months you would see the Japanese yen in the bottom spot here. Has been a consistent underperformer. As we've seen, of course, other central banks tightening interest rates, the Japanese have managed to finally move rates out of negative territory, but they didn't move it very far. Markets are expecting rate hikes over the course of this year, but that might at most seemingly total a 0.20, so 20 basis points hike. And given the fact that we're simultaneously seeing markets sort of pushing back these rate cuts from other central banks, most notably the Federal Reserve, it really does sort of negate a lot of the potential shift that could come in favor of the Japanese yen. Bear in mind, the back end of April saw action taken, and it seems like it was taken by the Bank of Japan. It was seems like FX intervention, where they're essentially trying to support their currency. And so we'll look at the chart for the Japanese yen within that sort of taking that viewpoint into consideration. So firstly, let's look at the wider picture. This is the last year, much like we've seen for the prior indices area. Apologies, I haven't moved all of these around, but I can tell you the bottom end is the Japanese yen here in red. We've got the likes of the US dollar outperforming here as well. Then we've got the pound, we've got the Swissy somewhere in the middle here, the Canadian dollar there as well, the euro. So we've got these three in the middle here, New Zealand dollar here, and the Aussie dollar here. So essentially, top end, you're looking at the US dollar, which has happened once again. The bottom end, you're looking at the Japanese yen, which has happened once again. So if you're looking for a consistent performer over the course of the past year, you've got to look at the US dollar against the Japanese yen. That's exactly where we're going to look now. And certainly if we're looking at the sort of long-term trajectory, this daily time frame highlights exactly how things have been playing out, particularly in 2024 thus far. But then if you're looking further out, it has been a very consistent performer. I've got a couple drawn on here, but there have been multiple intervention efforts made by the Bank of Japan in the past when it comes to trying to prop up the Japanese yen. And by and large, sometimes you might see a pullback off the back of it for a couple of weeks. Sometimes you don't necessarily see much, and immediately you see a breakout through the level that they were trying to support. One such level was 150, and you can see here that it was protected, and ultimately we saw it rolling over from this area once again. Are we going to see a protracted move lower now that they've essentially protected that 160 mark? Bearing in mind that came off the back of the BOJ rate decision. You can see that in the lead up to it, we saw the BOJ rate decision here. The pair rallied up to 160 and then they protected it just to drive it back down to where it was all of 24 hours earlier. So it didn't necessarily do too much for their money. And we've been seeing it climb ever since. And this really does highlight the concern that the Bank of Japan will be unable to really utilize their intervention to make a long-standing impact on this currency pair. Are they going to come out and actually start raising rates in a meaningful manner to try and protect the Japanese yen? That seems unlikely, quite frankly. And therefore, there is the possibility of further upside. We do have that consideration of looking at previous examples and saying sometimes you see a protracted move lower as people grow concerned that each time you come back up to that level in question, let's say 160 or this 158 to 160, that they're going to protect it once again. So it's sort of throwing a warning signs to markets. And you can see we've rallied up into the 158 and now starting to roll over a little bit from here. But certainly maybe we see some caution playing out over the near term, but the wider trend remains bullish. And certainly if the Federal Reserve portray a more hawkish stance going forward, and we continue to see inflation rearing its head, and certainly if you look at the inflation data over the past 2 months in particular, the month-on-month figures don't make for particularly reassuring reading, quite frankly. It does point towards a possibility of further sort of caution when it comes to rate cuts. That would likely be beneficial for the US dollar against the Japanese yen. So further economic strength for the US, further sort of caution from the Federal Reserve would likely benefit this pair. And, if you're looking for the Bank of Japan to enact quite radical policy when it comes to like driving up the value of the Japanese yen, it doesn't seem likely because that Bank of Japan meeting saw very little by way of significant talk around seeing major rate hikes over the course of this year, despite the fact that markets are expecting 2 10 basis point hikes to come into fruition. Then finally, I want to show you the breakdown for the commodity space. We can see natural gas up 12.4% on the top end. Precious metals doing well, particularly silver up 6% over the course of the month, despite a pullback at the back end of the month. And then palladium on the bottom end of things. So let's look first and foremost at that wider big picture view for the market as a whole over the course of the last year. You can see the best performing of these has been precious metals, gold and silver, particularly over recent months, doing really well. You can see that natural gas has seen a pretty topsy-turvy time. You can see those gains here in sort of back end of last year, tempered heavily with a sharp decline. And now we're sort of in recovery mode from that big decline. Palladium has been a perennial underperformer. It is the kind of market that doesn't necessarily carry favor for many because the view is that as we see the electrification of vehicles, EVs in particular, so some of the main uses for palladium, such as for catalytic converters, start to weaken as a story, quite frankly, as people move away from fossil fueled vehicles. So that palladium story isn't likely to go away, whereas the natural gas play in terms of being on the top end of things might just be a rebound situation. So let's look first and foremost at the chart for natural gas. So like I said, let's just go out to the long term. We saw that massive rally up, of course, the whole Russia-Ukraine issue. We've seen Europe by and large resolve that. They've got pretty much full storage tanks over the course of the winter. And that winter played out with price driving down as people realized we weren't going to see a sort of surge as Europe in particular were desperately trying to clamor for gas from around the world, which lifted not only European prices, but also US prices as LNG got shipped around to the highest bidder. Now, where are we? Well, we've essentially exited that phase where we see the drawdown of gas tanks, and instead we're now back into the phase where we see the filling of gas tanks. But by and large, they won't necessarily need to be filled by as much, so there's not necessarily going to be as huge demand. But nonetheless, we are moving into a phase where people will be buying up that gas where possible to try and fill those storage tanks. In terms of the chart, though, you can see, by and large, the trend has been bearish. You see this big decline over the back end of last year, moving into this year. And now we're in this sort of recovery phase. So if we're looking from a sort of sheer sort of percentage perspective, you can see why we've seen such a significant gain for natural gas, because quite frankly, if we saw a rebound up here, you would get, if we were getting a move here, you might get 5%. But if you're seeing a move down here, you're seeing sort of 10%, 15%. So because of the fact that it's sold off to such a degree, and because we've gone back down from sort of 3.5 down to sort of 1.5, 2, then you're going to get much bigger moves from a percentage perspective. Does the trend point towards further gains? Well, over the near term, it kind of does. I mean, look, we've got this trend of higher lows and higher highs playing out here. I'm just seeing if we can click that bottom end, but basically it's going to be like this, right? So we're sort of channeling higher at the moment. We've pulled back towards trendline support. So look, the wider trend does point towards downside, but this isn't a market that's likely to go to zero, and therefore we've sold off to such a heavy extent. You're looking back in from historical perspective, we're back down, we've come back down to the lows that we saw back in 2020. So I think there's a good chance that maybe we have bottomed out here and we could grind higher over the coming period. So, from a sort of demand perspective, I'm not expecting to see a huge shift in favor of natural gas demand, but nonetheless, we're seeing this pullback. Are we going to see this rallying once again? I wouldn't be surprised. We're seeing a relatively gentle slope, but gentle slopes can be beneficial for traders because you often get sort of decent sized retracements. This is a 61.8. The next one's again a 61.8. This latest move is a 76.4. So we do get nice deep retracements within this sort of relatively gentle slope. So things look like they could continue on this trajectory, but be aware you're essentially betting against the wider trend that has been bearish. It just looks like it's got down to the kind of levels that we could start to base out, and maybe there might not necessarily be that much downside left in the tank for a market that already has seen pretty significant declines, to say the least. You're looking from the top in October down to the bottom here, 55% declines over the course of maybe like 5 months, something like that. So pretty significant declines here for nat gas. And then Palladium, like I said, this is a market that is, if we can hopefully load this chart. One moment. Let's try and load a different one. Tell you what, let's try and load it on here. There we go. Right. So we're talking about trends. I mean, that's a hell of a trend, right? You mean throughout 2022 in particular, moving into 2023, we've just seen this market go down and down and down and down and down, right? So we have a very, very clearly defined trend here, which is a great thing. What's happened over the course of April? Well, look, we saw actually some strength playing out at the back end of February and March. We come into April and it's essentially just sold off that rebound, but that rebound essentially was set within a wider bearish trend. In terms of that trend, I mean, look, you can try and draw on sort of trend lines and everything, but you don't need it because you can very clearly see that you're trending lower here. The question mark is, where does that bearish trend kick in once again? In terms of the Fibonacci's, you can see here absolutely perfectly there, tagging the 61.8 on 2 occasions and seemingly rolling over. So here we go. This is the latest rally you saw in February. We rallied up into the 61.8. We've tagged it twice now, and those 2 peaks coming relatively in line with each other. So you start to drill down into the near-term charts. You can see nice double top formation with that 61.8 playing out. So you're looking at a neckline here. There you go, at this 972.72 mark. We've now broken through that level. So if we were looking from a sort of technical projection stance, we're looking for a projection towards the downside of 132. That would take us back down. There we go. So roughly 837. I wouldn't necessarily be looking for that right now, just because, you know, this is such a key level. I would look for that prior low as the key near-term level to be looking out for. And also, you don't necessarily need to take all of that move. I mean, ultimately, you need to try and find a trend that you think is going to continue and try and take portions of that. Within this, if you look at the sort of intraday chart, you can see very clearly that we are trending steeply lower. And we've got this nice pattern of lower highs and lower lows. So this most recent swing high is above the neckline of that double top formation, which is a good thing as well. So near-term upside, you know, for me, is likely to fade. If we break the 980 mark, then it starts looking like we could rebound into a wider retracement. But we've got a very clearly defined long-term downtrend in play here. We've rallied up into the 61.8, posted a double top formation. For me, this looks like a key market to be watching out for in terms of trend-wise, because the bearish trend is long-standing. It's playing out both the short term and the long term, and that's exactly the kind of market you should be looking out for. So Palladium, another key market to be looking out for, and stands in stark contrast to the so-called winner of the month, which has been natural gas, which, yes, natural gas enjoyed a good month, you know, but ultimately you look from a big picture perspective, it still is a troublesome picture, despite the fact that we could potentially grind higher over the near term. But Palladium looks particularly interesting given the long term and short term declines that have been playing out.